In this video, we're going to talk about hedge fund market wizards Scott Ramsey's rules for success and some of his mistakes. Stay tuned. Hey traders, a very warm welcome to you. So, hedge fund market wizards, I'm going to stick a little screenshot of it up here. I listened to it on Audible. I don't have a physical copy of it, but I've listened to it so many times. And one of the guys from it, Scott Ramsey, one of the traders, a futures trader, has some really interesting points that he's made. And so I've highlighted a few of them here, and I'm going to read from some of the excerpts of the book here, and we can run through exactly some of his rules for trading success. So, Scott Ramsey is a futures trader, and he trades based on a fundamental thesis, but then adds a technical kind of twist to it. I love that kind of approach because he's got a reason for the trade. He's not a pure fundamentalist, he's just going into the trade regardless. He's saying, you know what, the fundamentals support a bullish thesis, a bearish thesis, whatever it may be. Let me now find a technical entry based on price action so I can quantify the risk, I can have a decent target, I can frame the trade nicely in a technical perspective with the kind of, I would say the tide, if you like, of good fundamentals or bad fundamentals, pushing it from a kind of a headwind or not, or tailwind, should I say. So I like that approach. That's a good approach. Anyway, let's have a look at some of the things, the comments he said. The first thing he said was mistakes, really. He said, listen, I made a lot of mistakes. And rather than kind of trading with the trend, in other words, matching his fundamentals, looking for, I guess, a pullback to get on or a breakout, he was trying to pick tops and bottoms. And so he would sit with losers that weren't working for him. He would take small profits. And that's the classic thing, guys. I think a lot of traders are stuck in that rut, if you like, of, hey, they're not really pushing themselves to push the winners. They're banking the winners too soon and they're holding the losers. And yes, they make a little bit of headway with it. They kind of, try and hold the winners a little bit longer and cut the losers a little bit shorter, but they never seem to get to the point where, hey, this is a trade that's worth holding. I need to hold it. Leave it alone. Leave it alone. Do not touch it. And the same vice versa with the losers. Hey, this isn't working out. I need to just cut it and move on. Forget about it. A lot of traders will stick with it. And of course, over time, we know if we hold on to losers and not winners, it's just not mathematically feasible. Not mathematically feasible for us to make long-term profits from doing that. All right. Next thing was a mistake, is he withdrew money from an account. This is an interesting one. I don't think I've covered this before in a video. Let me know in the comments section below if that's something that interests you. He basically said, hey, listen, when I made money in my account, I'd pull it out. And so instead of increasing his position size and being able to increase his position size and obviously his profits from that and his incremental income and his account size is really what I'm looking for, he would pull it out. So I guess, say made 20 grand, he would pull it out and say, thanks, I've made 20 grand. So what he was saying is, I was always stuck as a kind of 1 and 2 lot trader. So if we were trading, if we're spread betting, we're talking, depending on the market, whatever, maybe we're talking £10 a point, £5 a point, that kind of stuff. He never, £20 a point, he never really got to a point where, hey, you know what? Yeah, take some money out if you want to, but leave some in so I can increase my position size. And one of the things he said is, listen, the evolution of a trader is when you start letting your money work for you and increasing your size. You don't want to stay a 1 or 2 lot trader or small trader forever. If you're making money, leverage on that money a little bit. Take a little bit more position size, take a little bit more risk a little bit more of that capital so you can push the boat a little bit more aggressively. Okay, the next one is he was flexible in his approach. And the way he framed this is he said, listen, he has investors in his fund, and he would say to his investors, listen, you know what? I'm not being paid to be right. I'm being paid to make money. So, if I say today that I'm bearish on this stock or this market, I might be bullish tomorrow. And I might say I'm bearish, but I may not have a short position on. And this is kind of really interesting, I think, from a perspective that, hey, you might have an idea or something's bullish or something's bearish or whatever it may be, but we don't make money from that. We make money from trading it and making the difference between the level we buy at, the level we sell at, or level we go short at, and level we cover at. That's how we make money as traders. We're not being paid to make calls on the market. Calls are for the guys on the media, the talking heads, and they can go, yeah, I made this call. There's a lot of difference between making a call on something and making a trade. You might think, that something's going up, but you can't find a good entry to manage the risk in it. You just don't want to take the trade. And that's pretty much what he's saying. He's saying, listen, I'm flexible. I might be long one day, I might be short the next. I might believe I'm bullish on this market, but I might not even be long on it. I might be waiting for a short on it. I might be bullish, but saying, you know what, I've missed the meat of it. I'm now going to wait for some sort of criteria that allows me to go short. I like that because he's basically saying, you know what, it's you're not being paid to be right, you're being paid to make money. Risk control. This is the theme that we see with every single good trader, every single one. No trader says anything other than you've got to be rigorous with your risk control. Keep your losses small, you know, and make sure you're in a position to be able to take advantage of the opportunities. That's an interesting comment because basically saying, listen, if you're not keeping your losses small and you're getting hammered all the time, you won't have the capital to push in when the times are there. And this is something else that a theme from other good traders is, you know what, if a trade's not working, cut it. Get rid of it, move on so that you have the firepower to push in when the trade is right. And something else he says here is, hey, if a trades aren't working and your mental energy is going towards damage control, you can't think clearly about the opportunities in the market. So on one hand, he's saying, yes, you need the capital to push in when the market conditions are right. But the other hand, which is probably what he's really getting at, and what makes a lot of sense, is that listen, if you're constantly thinking about this bad trade and how do I, you know, cut the damage on this, and you know, oh, this is losing me money, and your mental energy is going into that, what he's saying is you're going to miss the opportunities elsewhere, the profitable ones. And really, you know, what's losing you money, it's causing you grief. Ditch it. Look with a clear mind. You know, your attention is drawn to the one you shouldn't be. He's saying, listen, you want to be able to think clearly about other opportunities that present themselves. Really good idea. That I really like the way he's put that. The other thing, final thing he's put is say, listen, the market doesn't care. We talked about this before, guys. It doesn't care if you lose money or make money. It does not give you know what. It doesn't matter. Think about your next trade. Forget about your previous ideas. Just because you lost money on it doesn't matter. It's just look at it. You're not going to make money in every trade. If an idea is right, you know, randomness, as he says here, might just cause you to have a losing trade. Stick to the process, get the process correct, or something that he said, and just keep pushing forward. Keep trying to make the right decision for long-term trading success. All right, guys, that's Scott Ramsey. Maybe we'll cover some more guys from the Hedge Fund Market Wizard series. But if you haven't got the book or haven't got the audio book, thoroughly recommend it. Recommend the Market Wizards series anyway, but definitely the Hedge Fund Market Wizards book or audio book by Jack Schwager. Thumbs up, like this kind of stuff. See you in the next one. Take care. Get your risk managed. Goodbye.